Good evening. This is FactWire Report. Tonight, new U.S.-China trade tensions reshape global supply chains, while America's largest bank launches a decade-long financing push into strategic industries. We focus on what these moves could mean for prices, jobs, and innovation across the U.S., Europe, and beyond. The U.S.-China trade dispute is intensifying again. After Washington signaled tougher import duties and port fees, Beijing warned it would respond, including with restrictions on key industrial minerals. President Trump has threatened tariffs of up to 100% on Chinese goods, framing the move as leverage in ongoing talks. Markets are watching closely. Higher duties can raise input costs for manufacturers and consumer prices for households. But companies may also shift sourcing or accelerate investment at home. Working-level discussions continue, and a possible leader-level meeting remains uncertain. For viewers, the takeaway is simple. Supply chains and inflation paths could be bumpy in the near term while policies and negotiations evolve. Up next, Wall Street's biggest bank maps a decade of financing for critical industries, from energy to manufacturing, and what that could mean for jobs and resilience. JPMorgan Chase unveiled a 10-year, $1.5 trillion security and resiliency initiative to facilitate, finance, and invest across strategic U.S. sectors, including energy, manufacturing, critical minerals, and defense-adjacent technologies. The bank plans to commit up to $10 billion in direct equity and expand banker coverage for targeted industries. Management frames the program as supporting national competitiveness and supply chain stability rather than short-term stimulus. For communities, potential outcomes include new projects, hiring, and capital access. For investors, watch the pacing, credit risk, and policy alignment. The move coincides with broader debates about industrial strategy and trade policy, signaling that private finance intends to be a long-run participant. Ahead, energy strategy and regulation, how policy shifts could reshape costs, investment, and the pace of innovation in the months to come. JPMorgan CEO Jamie Dimon warned that the U.S. has become too reliant on unreliable sources for critical minerals, products, and key technologies that underpin economic and national security. His remarks accompany JPMorgan's new decade-long financing push to bolster strategic industries, including advanced manufacturing, energy systems, and frontier tech. The message: supply chain resilience is now a competitiveness issue, not just logistics. For households and businesses, potential outcomes include more North American sourcing and new investment in processing and grid equipment. Yet trade frictions and permitting bottlenecks could slow progress. Watch for concrete project announcements and how public policy aligns with private financing over the next quarters. Coming up, fresh signals from forecasters. Could slower tech spending tip the U.S. toward a softer patch, or will AI momentum hold the line? Oxford Economics recently cautioned that if U.S. tech investment cools, growth could fade and recession risks would rise. The logic: 2025 momentum has been unusually concentrated in AI-linked CapEx. A slowdown would hit equipment orders, hiring, and state-level activity. Newer readings from the IMF backstop the narrative. AI spending has helped shield the U.S. from a sharper slowdown, yet markets remain vulnerable to a correction if expectations outrun earnings and productivity. For viewers, two indicators matter most: CapEx plans from big tech and broader financing conditions. If both weaken, softness could spread beyond Silicon Valley. If they hold, the baseline remains moderate growth with elevated volatility. Ahead, policy moves in Washington, budgets, energy, and oversight that could sway investment plans before year-end. In Washington, negotiations over the federal budget have stalled, raising the risk of a partial government shutdown. Lawmakers are divided on spending levels for key departments, with debates centered on defense, social programs, and disaster relief allocations. Temporary funding expires within days, and without a deal, thousands of non-essential federal employees could face furloughs. Essential services like air traffic control and Social Security payments would continue. Economists say each week of shutdown could trim GDP growth slightly and dampen confidence. The White House and congressional leaders signal they aim to bridge differences, but the clock is ticking toward another fiscal showdown. Up next, AI investments keep powering the economy, but can that momentum last as interest rates stay high? Artificial intelligence investment continues to underpin much of America's 2025 expansion. From chip manufacturing to software and cloud services, capital spending tied to AI has offset weakness in other sectors. Analysts say this surge could add 0.3 percentage points to GDP growth this year, though sustainability remains uncertain as borrowing costs stay elevated. Some firms are already reassessing projects that depend on consumer demand or policy incentives. Economists stress that productivity gains, not hype, will decide whether AI becomes a long-term growth engine. For now, corporate pipelines for data centers, semiconductors, and training infrastructure remain robust, signaling that technology remains the economy's bright spot. Next, from global finance to innovation hubs, Money 2020 USA 2025 shows where technology meets strategy on a global stage. Money 2020 USA 2025, one of the world's leading fintech gatherings, opened in Las Vegas with the theme of Where Innovation Meets Action. Global banks, startups, and tech providers unveiled new tools for digital payments, AI-driven compliance, and cross-border finance. Executives from JPMorgan, Visa, and Stripe highlighted the shift toward real-time settlements and tokenized assets within regulated frameworks. Panelists said the focus is no longer on disruption, but on collaboration and security. The event underscored how AI and cloud infrastructure are reshaping back-office operations and fraud prevention. For viewers, the takeaway is clear. Fintech is entering a pragmatic phase, innovation anchored in regulatory and economic reality. Up next, policy and oversight take center stage as big tech faces renewed antitrust scrutiny in Washington. U.S. lawmakers and regulators are reviving bipartisan efforts to examine market power in big tech. A new congressional oversight panel will review mergers, data use policies, and AI-driven advertising platforms. The Federal Trade Commission and Justice Department say their goal is to update enforcement for a digital economy, not to target specific companies. Industry analysts expect that increased transparency requirements and self-audit standards could follow. Tech giants stress they welcome clear, consistent rules. For consumers, experts note, the impact may show up in pricing and data options rather than in daily service use. The renewed scrutiny marks another turn in the global conversation about competition and innovation. Still ahead, energy and legislation, a new America First energy plan, and the AI regulation bill that could reshape U.S. policy. The White House has unveiled its new America First energy plan, focused on reducing U.S. dependence on foreign energy sources while accelerating domestic production of oil, natural gas, and renewables. The plan sets targets for expanded LNG exports, streamlined drilling permits, and tax credits for next-generation nuclear and hydrogen projects. Supporters say it will strengthen energy security and job creation. Critics warn it could slow the clean energy transition. The administration frames it as balanced diversification, aiming to stabilize prices and supply chains amid geopolitical tensions. Analysts expect mixed reactions from markets, but agree the policy will shape capital flows across the U.S. energy landscape through 2030. Finally, tonight, Congress debates a sweeping AI regulation bill that could redefine data privacy and algorithmic accountability. Congress is weighing a comprehensive AI regulation bill aiming to set nationwide standards for data privacy, transparency, and algorithmic accountability. The proposal would require large AI developers to register risk disclosures, undergo third-party audits, and allow users to contest automated decisions. Lawmakers cite raising concerns over bias, security, and data use by both private firms and government agencies. Supporters argue it will build public trust and prevent misuse. Opponents warn it could slow innovation. Tech leaders call for balanced rules aligned with Europe's AI Act. The debate underscores Washington's effort to stay ahead of global AI governance while protecting civil rights and competitiveness. That wraps up this edition of the FactWire Report. From trade wars and investment drives to AI regulation and energy policy, America's economy is being reshaped by both innovation and uncertainty. I'm your host. Thanks for watching. Stay informed, stay balanced.